Good evening, dear traders. Today we will touch very interesting instrument because that is a good example how short squeeze works. So S&P 500, and it continues to show a very strong upward momentum, and it is important to understand that the market is not rallying because geopolitical risks have disappeared. On the contrary, the Middle East conflict remains an unresolved source of uncertainty. However, the market is currently focused on something else, the ongoing impact of the short squeeze. Weeks ago, reports emerged including references to Goldman Sachs data showing that hedge funds had accumulated an extremely large volume of short positions. A significant portion of those shorts has since been forced to close, and that process became one of the key drivers behind the rally. During the escalation phase, bearish positioning reached extreme levels, and the market then aggressively squeezed sellers higher. At the same time, the fundamental backdrop remains relatively stable. The US labor market has not shown severe deterioration. ISM and GDP data are still holding in relatively stable territory. The economy has not yet entered a full slowdown phase. Yes, inflation accelerated due to rising oil prices. You can see here WTI and that extreme rise from the beginning of this conflict. So it's important to understand this mechanism. Initially, markets can continue rising through asset inflation momentum. This is a normal inertia phase. Liquidity and short squeezes can support the rally much longer than many market participants expect. Only later does the market begin pricing in the next stage: slowing demand, weakening economic data, deflationary risks, and softer corporate performance. But for now, the primary trigger remains geopolitics, since the Middle East conflict has not reached a final resolution. The market continues trading on current momentum and liquidity flows. Technically, the structure also looks very telling. The market previously formed a deep bearish trap below 6,600. So you can see here this huge bearish trap. Then moved through the major high volume zone near 6,870, and after which the accumulated positioning expanded into a strong impulsive rally higher. At the moment, the market appears locally overextended, but there are still no clear signs of buyer capitulation. That is why the bullish momentum remains intact despite the ongoing external risks.